If you are around 55 years old or approaching your 60s, and your entire retirement portfolio, your 401k, your IRA, your brokerage account, is sitting 100% in the stock market, I have some incredibly uncomfortable news for you. You are not investing for the long term. You are playing Russian roulette with the last 30 years of your working life. For the past decade, financial TikTok, young YouTube creators, and even some mainstream advisors have repeated the same mantra. Just buy index funds. The S&P 500 always goes up. Look at Apple, look at Nvidia, look at Microsoft. And if you're 25 or 35, that is fantastic advice. If the market crashes 40% tomorrow, a 30-year-old has decades to wait for it to recover. They don't care. But you don't have 20 years to wait. If the market drops 40% next Monday, your retirement date just got pushed back by a decade. Today, we are going to look at the cold, hard mathematics of why the 100% stock portfolio is financial suicide for anyone over 50, and exactly what the Wall Street elites are doing with their own money right now while telling you to stay in the market. Let's dismantle the biggest lie in modern finance. The market always recovers quickly. Let's look at history. Not ancient history, but a time most of you remember vividly. The year 2000. The dot-com crash. If you were 100% in stocks back then, your portfolio collapsed. Do you know how long it took just to break even? To just get your original money back adjusted for inflation? 13 years. It wasn't until 2013 that the market truly recovered from the 2000 peak. Now, imagine you were 55 in the year 2000, planning to retire at 62. Suddenly, your $1 million portfolio becomes $600,000. You can't wait until 2013 to buy groceries, pay property taxes, or cover your health insurance. You are forced to sell your shares at the absolute bottom just to survive. This is what economists call sequence of returns risk. It is the most dangerous invisible monster in retirement planning, and a 100% stock portfolio makes you completely defenseless against it. Let's do some basic math. Wall Street loves to talk about average returns. They say the S&P 500 averages 10% a year. Average returns are a mathematical illusion that will bankrupt you. Imagine you have $1 million. In year one, the market crashes by 50%. You now have $500,000. In year two, the market rallies and goes up by 50%. What is your average return? 0%, right? Minus 50% plus 50% divided by 2 equals 0. But how much money do you actually have in your account? 50% of $500,000 is $250,000. You now have $750,000. You didn't break even. You lost $250,000 of real purchasing power, even though the average looks fine on paper. To recover from a 50% drop, your remaining money has to grow by 100% just to get back to where you started. If you are 58 years old, do you have the stomach, the time, or the health to wait for a 100% market rally while inflation is eating away at your cash? And it gets worse. If you are already retired or semi-retired, you are withdrawing money. If you withdraw 4% from a dying portfolio, you are compounding your losses. It's like bleeding from an open wound and putting a vacuum to it. Why am I making this video right now? Why is this critical today? Because by every historical metric, the U.S. stock market is currently trading at some of its most expensive valuations in human history. The Shiller P/E ratio, which measures stock prices against corporate earnings over 10 years, is sitting at levels we've only seen right before the 2000 crash and the 1929 Great Depression. The market has been driven by massive government money printing and hyper-hype around artificial intelligence. A few massive stocks, the Magnificent Seven, are carrying the entire weight of the American economy. If you are 55, you lived through 2000. You lived through 2008. You remember the fear of watching your account balances evaporate. Back then, you were younger. You had time to work, make more money, and buy the dip. Today, your ability to exchange your time for a high salary is shrinking. Greed is a young man's game. For you, the game is now about preservation. Let's talk about something that nobody on Wall Street wants to admit. The psychological toll of a market crash when you are 55 versus when you are 25. When you are young, a market correction feels like a sale at a department store. You see prices drop and you think, great, I can buy more shares of my favorite companies at a discount. You have a stable job, your income is likely rising, and you can sleep soundly at night knowing you won't need that money for another 30 or 40 years. But when you cross that 50-year-old milestone, something in your brain shifts, and it should. You realize that you have fewer working years ahead of you than behind you. Your energy levels change, the job market becomes less forgiving to older workers, and your health costs start to creep up. If you wake up tomorrow and see that your retirement account just lost $200,000, you don't look at it as a discount. You look at it and realize that 2 or 3 years of your hard work, your sacrificed weekends, and your missed family vacations just evaporated into thin air. That kind of stress doesn't just affect your bank account. It affects your health, your marriage, and your peace of mind. Many people think they have a high risk tolerance until they actually see the bloodbath on their screen. By then, it's too late. Out of panic, they sell everything at the absolute bottom, lock in their losses, and never recover. There is another hidden trap that a lot of people in their 50s fall into, and it has to do with how your retirement accounts are structured. If most of your money is in a traditional 401k or a traditional IRA, you need to understand that you do not actually own 100% of that balance. A massive portion of that account belongs to the Internal Revenue Service. You haven't paid taxes on that money yet. Now look at what happens if the market crashes by 30% and you are forced to start withdrawing money because you lost your job or had a medical emergency. You are forced to sell your stocks while they are down, which is bad enough. But then when you pull that money out to pay your bills, that withdrawal is taxed as ordinary income. So not only did the market take a massive bite out of your portfolio, but the government is going to step in and take another 20 or 25% of what's left. This is how a seemingly comfortable $1 million portfolio quickly dissolves into $400,000 or $500,000 of actual, usable purchasing power. When you are 100% in stocks, you are exposing your future tax liabilities to maximum market volatility. It's a double whammy that most retirement calculators completely ignore. We also have to address the myth of the safe tech stock. Over the last few years, companies like Microsoft, Apple, and Alphabet have come to be viewed as the new bonds. People think, well, even if the market gets rocky, everyone will still use iPhones and Google, so these stocks are safe. This is a dangerous delusion. In the late 1990s, there was a group of stocks called the Four Horsemen of Tech: Cisco, Intel, Microsoft, and Dell. Everyone thought they were invincible. They were the biggest, most profitable companies on earth. Then the dot-com bubble burst. Cisco lost nearly 90% of its value. Intel dropped over 80%. Microsoft took 14 years just to get back to its year 2000 price. Great companies can still be terrible investments if you buy them or hold them at the wrong price and at the wrong stage of your life. The goal of your 50s is not to hit a home run. You don't need to double your money anymore. The goal now is to prevent a catastrophic loss that forces you to work until you are 75. Wall Street sells you the dream of infinite growth because that's how they keep your money in their system. But true financial freedom at 55 isn't about chasing the next tech rally. It's about knowing that no matter what happens to the stock market on Monday, your lifestyle, your home, and your dignity are completely secure. So, what is the alternative? Am I telling you to sell everything, put cash under your mattress, and buy gold? Absolutely not. But you need to move from an aggressive growth mindset to a capital preservation and income mindset. First, fixed income is no longer dead. For years, bonds and cash paid 0% interest. But today you can lock in 4% to 5% guaranteed returns using short-term U.S. Treasury bills or high-yield savings accounts. It's boring, yes, but boring pays for your medical bills. Second, use the rule of 100 or 110. It is a classic rule of thumb. Subtract your age from 110. The result is the maximum percentage of your portfolio that should be in stocks. If you are 55, that means no more than 55% in stocks. The rest should be in safe, income-producing assets. Third, shift to dividend aristocrats and value. If you do hold stocks, move away from high-flying tech companies trading at 40 times their earnings. Look at companies that have paid dividends through every recession for the past 50 years. Consumer staples, healthcare, utilities. They won't double your money in a year, but they won't drop 60% in a month either. Wall Street makes money when you trade. Financial institutions make money when you keep your funds in their high-fee, aggressive mutual funds. They want you to stay 100% invested because they collect the fees, regardless of whether the market goes up or down. Don't let their marketing ruin your peace of mind. You've worked too hard, survived too many recessions, and sacrificed too much to lose your financial freedom in a single market correction. Take a look at your portfolio tonight. Calculate exactly how much you would have left if the S&P 500 dropped 35% tomorrow. If that number frightens you, it's time to reallocate. I want to hear from you. If you are in your 50s or 60s, what percentage of your portfolio is currently in stocks? Are you comfortable with the risk, or are you looking to diversify? Stay safe and protect your hard-earned wealth.